Hello, everybody, and welcome to today's Monday Mortgage Update. My name is Sean Wohland with the Wohland Mortgage Team. And last week was a whirlwind. When I say a whirlwind, we had the Fed cut the Fed funds rate by a quarter. But what did mortgage rates do? Well, I'll show you in a second, but they didn't get better. So let's dive into what happened with mortgage rates and what we can expect as we move forward through the week. So definitely not the best week when it came to mortgage rates, but still not bad. Let's jump right into it. So overall, mortgage rates did go higher, and because there was a cut of 25 basis points to the Fed funds rate. So what exactly does that mean? Well, the government controls the economy with two levers. They have to keep in mind the cost of goods and overall, which is inflation, and overall jobs. So the cost of goods or inflation, they made some comments after they cut the rates by a quarter for the Fed funds rate. They made some comments that sounded very hawkish. Basically, they were worried about potential inflation due to tariffs and due to other factors. But they're also worried about the jobs market, but they're more worried about inflation. And this sent a little ripple through the investment world in the bond market, and it was not good for mortgage rates. So when the Fed cut by a quarter in the morning, mortgage rates were actually having a pretty good day. And then what they actually said, what Powell said during the meeting with selling off the balance sheet, with inflation fears, it didn't sit well. So mortgage rates since then have gotten worse. Today and this week, we have a lot of the Fed governors talking. And today we had one speak, and again, very hawkish, very fearful of potential inflation because of tariffs. And in the Fed right now, there's a big disconnect between different parts of the different people in the Fed governing within the Fed. Some think we need to cut more. Some think we don't need to cut at all because they're afraid of inflation. So what's going to happen? Well, time will tell. But it's really interesting to see the back and forth within the Fed itself. So let's look to see what mortgage bonds actually did. So if you look back on August 22nd, I'm going to go ahead and annotate here. So if you look here, that is when the Feds talked about cutting the Fed funds rate by 25 basis points. And the markets, excuse me, sorry about that. The markets had a very good day. You see the bond market improved. We saw probably a quarter better in rate that day. That was a really good day. Then we went up to this Fibonacci level, bounced off it. It took us a while to pierce through, but we did. We went up to the next one. We actually pierced through, but then came back down. And then when the Feds actually cut the interest rates, which is this day right here, you can see we went up. Mortgage rates, mortgage bonds started the day rising, and then the Feds talked. And then Powell opened his mouth with talks of fears of inflation, and then the mortgage-backed securities lost. Then the very next day, they lost again. Then they lost again. We saw a little bit of a bounce off this Fibonacci level on Friday, and we stopped above it, which was good news. That meant this layer, this floor of resistance, it stuck. But unfortunately, today, we lost ground. We are now closing behind or underneath this Fibonacci level. We are right here on the 25-day moving average, so that's good. That held us. But if we go below this, we have a lot more room to fall. We have about, well, I would say about 40 basis points where we could lose to the next one. So we're not in a really great spot. We are holding on this layer of resistance, so we'll see if we can keep this. Maybe we can pop back into this section. But we've got 10 Fed governors speaking this week, half of which think we should not cut rates. Half of them think they will. So it's going to be really interesting to see what happens this week. And then if you look at the 10-year, you'll see how we were down here. We pierced below the 4% mark for just a tiny little bit. And then, well, it didn't stay there. The 10-year ran all the way up to close to 4.1, and then it dropped down and settled down into the 4.6, 4.7 range. So now, since then, We've gone above this Fibonacci level. We tried to stay on it, but now we're above it going up to the next level, which is the 25-day moving average. So again, not in a good place. So today we actually locked a few loans because there's more to lose than to gain. And that's where we're at. So here's where interest rates are at. Let me get rid of these little check marks here to show you what's going on with the interest rates. So last week we were in the 6.2 range. Now we're in the 6.35 range. So yes, rates have gone up. They're still good. So the news is going to say rates spike or rates are up. They're not. They're still good. They're not as great as they were. They got down to 6.1, which, believe it or not, was the same level that they reached about a year ago. And they were there for about a week. And guess what? 6.125 was here. And guess how long? For about a week. So I was able to lock in quite a few refinances at that 6.125 because I knew it'd be fleeting. But if there's people looking to purchase and they're trying to time the market for when rates hit their lowest, guys, that's a futile quest. It's not going to go well for most people. You can get lucky, but for the most part, if you're looking for a home, don't look at homes and try to time it with when rates hit their lowest point. You can always refinance. That's always an option when rates do hit a low, and you can absolutely time that because you already own the house. But if you need to buy a house, go buy the house you fell in love with. Don't try to time it with rates. So we're in the 6.35 range. Again, that's for the perfect borrower, 25% down, primary residence, over 400 loan amount, single family detached home, owner occupied, the perfect borrower. So if your credit is less than perfect, you may be in the high sixes. You could be even in the sevens. It just depends on your overall picture. But the perfect borrower in the low sixes right now. Hope you enjoyed this update. You guys have a great week, and we will be in touch. We'll talk to you guys soon.